Welcome to the Rental Realm podcast. My name is Jay Ullrich. I am here with Ryan Bakke, the CEO of Tax Strategy 365. Thanks for being here, man.
It's awesome to be here with you, Jay.
Cool. Yeah, I appreciate you sitting down, taking some time. We are going to be going over some tax strategies. I got a bunch of tax-related questions for Ryan. He's a CPA, professional in his field, saves real estate investors a lot of money every year. So excited to get into that. I guess first off, we can start off. My first question for you to share with the listeners would just be, what do you do and why?
Yeah, so I help real estate investors save millions of dollars a year on taxes. A lot of what I've also been doing lately is helping real estate investors really maximize every single dollar that they have invested. Because when you're working a W-2 or you're working a job you may not like, or in your field you just don't love and you want to get out, you have to make sure that every single dollar that you have is working hard enough for you. So recently for our Tax Strategy 365 clients, we've also been doing what I just call portfolio audits. So it's looking at your portfolio, maybe 3 or 4 properties, figuring out which ones have a lot of equity in them that may or may not be making a lot of money, and then kind of selling off the ones that are bad and keeping the ones that are good for yourself, right? It's a very easy analogy when you think about a pumpkin patch or a pumpkin farm. So when you go to a pumpkin farm, the pumpkins that they sell to people are like 10% of the total pumpkins that were produced. That's because the farmers axed all the pumpkins that basically didn't make the cut. Sometimes you see some pumpkins in there that look really bad, and those are the ones they should have cut away. But it's just the same analogy. So helping investors make the most of their money also, and then they need to come up with a strategy to help save money on taxes too. Public speaker, influencer, entrepreneur, I hold a lot of titles, but it's all centered around real estate.
Yeah, I think one thing that really stood out to me, I guess for the viewers or listeners, I met Ryan Bakke at the STR Nation conference in San Diego. So in my hometown of San Diego. Ryan, I believe, comes from Chicago, right?
Yep.
Beautiful. Yeah, I think just the awareness of real estate specific tax strategies was really cool. It just you're one of the only CPAs that I've seen who's really had like a passion to share tax strategies with people instead of just checking off the boxes. I've been with a few different CPAs and people have done my taxes in the past, and it's kind of been that way. It's a big investment to be able to get all your papers together and provide it to somebody and make sure, it's a big trust relationship that you have with you and your CPA. So it's a big deal. It's when you're choosing somebody like that. But I think, Ryan does specialize in real estate investing. So that's very helpful for people like us. But yeah, I think, I guess one question that I have for you is, what is I guess the biggest mistake you see when beginner investors come to you about buying their first property?
Yeah, one of the mistakes I see when they buy their first property is the paralysis analysis. And it's so funny because investors are either in one camp or the other. You got the investor that's like, oh, I need to have this complex LLC set up, and I need to have a management company over here that's leased by my trust, and this, like all this sort of stuff. Like the paralysis analysis of just how am I set up the right way for legal and tax purposes, right? And then you got the other camp of investors that are just super gung-ho, that are out there buying properties in their personal name. They don't even have a lot of people that are buying these secondary homes or buying properties as secondary homes. Those insurance policies don't cover rental use, and a lot of people don't know that. So it's like these investors are either in one camp or the other. They're either super paralysis analysis or they're like way too gung-ho, and I think there's a fine line where investors have where they should be analyzing, can I get better terms and rates in my personal name, or from an entity perspective, because I am a high net worth individual, like should I be buying these in LLCs in the first place?
I guess that's a perfect segue into one of my questions that I was going to ask you is, I know for me, like I'm a short-term rental operator. I've purchased one home that I use as a rental. What is the best business structure going into, I guess, for short-term rentals specifically? Right now we have an LLC. I've heard a lot about S corps. Once you start making a certain amount of revenue, Is there one that you always preach is like, this is how you should start and this is what you move into, or how does that
Yeah.
work?
Well, you just have to remember you're always going to get the best rates, the cheapest rates, the quickest rates in your personal name. It's always going to be quickest, cheapest, easiest to buy your first property in your personal name. But once you achieve a certain net worth status, and if I had to throw a number on there, I would say right around 500K. But once you achieve a certain net worth status, it's like, okay, well, now I need to start worrying a little bit more about asset protection. Because if somebody slips and falls on that property and they look online who owns it, my name shows up, right? And that's a liability because then they start doing more digging. They find out that I work in tech and I got stocks, or I'm a doctor or a lawyer or a dentist, whatever the case may be. Then they're going to want to come after me. But then you graduate, and the best sort of structure. So if that's you and you're buying property in your personal name, you want to have a really good umbrella insurance policy. Really good insurance policy, typically 2x or whatever your fair market value is of your properties. So you buy that personal name, really good insurance, and then you move on to just a single member LLC. So you have a single member LLC that's in the state where the property is located that owns the property. And that's it, just to start. You either have it in your personal name with really good insurance, or you have it in a single member LLC in the state where the property is.
Cool. Gotcha.
Mm-hmm.
That's essentially where we have a multi-member LLC. But yeah, essentially taking it. I guess once you get to a certain point, is there a tax advantage to switching over out of an LLC? Because I know, like for us, I mean, we don't actually own our properties now. A lot of the ones that we manage is just management fee.
Mm-hmm.
So I think we have like 36 properties now, but our revenues, I mean, it's getting up there.
Well, you brought up a good point, and that's the difference between what I call active income, which is income that you would make at a W-2 or a day job or by property management, and then what's called passive income with properties that you actually own. Because properties that you actually own that are passive, you want those in a single member LLC or a multi-member LLC if there's more than one person. But if you have active income via W-2, via property management, that's income that you do probably want funneled through an S corporation. So you just want LLCs for properties that you own, but you want to have an S corporation for any sort of active business. So like I have a CPA firm, I have a consulting firm, education firm, all those are S corps. But the properties that I own are under LLCs. And that's how you want to be set up.
Okay.
Mm-hmm.
And for your services with Tax Strategy 365, what type of clients do you work with typically?
Typically, so I would say the good mold for a 365 client is somebody that's got a net worth, I would say close to or over $1 million, and has at least 2 to 3 properties is typically who we're working with. I am launching a new company called RE Tax Prep that's going to basically service people who just bought their first rental or have like a sub $1 million net worth. It's just they're not getting all the nuts and bolts and the strategic thinking that the 365 clients are. But I'm trying to figure out a way that I can help everybody. It's just, as you know, it's really hard to help everyone. You kind of just find the person and help them. But I'm learning and growing along the way.
Yeah, definitely. So for those people who have, so let's say like for example, I know one struggle that I had when I was buying my first home was I don't have a W-2 income. It was hard getting approved for a loan
Mm.
for anything under 20% down. Is there any advice that you give to people who are in the same boat, who maybe they have their own SDR business and they're managed, but now they want to buy, or somebody who's just looking to buy their own and they are self-employed?
You have to be, you have to have a very intimate and close relationship with your debt to income and kind of what shows up on paper, how you're managing your credit score, the relationship that you have with lenders. Because as you know, I mean, it might be one of the hardest thing on the planet to get a loan if you're self-employed. I mean, I just bought a new primary in February, and like it was easier when I was making 50K as a W-2 to buy a house than it was making, I don't know, 500,000 self-employed, running my own business. Like that's how harder it is to buy if you're self-employed. It's ridiculous. as an investor, the number one thing that you can do is protect your debt to income. So you really want to do a lot of education and training on, okay, this income stream over here, how does that affect my debt to income? Oh, I just had this property for a year. Is that going to help me or is that going to hurt me? Right? Or like the property that I'm about to buy, and this is the most important question that you should always ask yourself before you buy a property. Where does it set me up in the future? Because I see a lot of investors that they use a 10% down secondary home loan, and then boom, their debt to income's maxed out. They can't buy another property for a year or 2 years. They got to wait for those tax returns to come in to show income. So the number one thing you can do is learn how to protect your debt to income. And that starts with figuring out how you can set yourself up, not only for the next deal, but the deal after that. Because I like to shoot pool, like when I'm at a bar or out with friends. And I take a lot of time when I'm about to shoot. And people are like, what are you taking so much time for? Like, that's the easy shot. And I said, well, I'm not worried about that shot. I'm worried about where my cue ball is going to end up after I hit that one in, right? So as an investor, you're trying to scale a portfolio. You got to be thinking 2-3 deals ahead. It's not enough to just think about the property at hand. You have to be thinking a couple of deals ahead if you really want to scale your portfolio and do well in this business.
Could you give a hypothetical using numbers for an example of like a good debt to income ratio?
Yeah, general rule of thumb is there's a bank out there somewhere somehow that'll loan you up to 5x of whatever your active income is. Okay, so if you got $100,000 W-2, there's a bank out there somehow, some way that'll find a way to give you $500,000. It doesn't mean you should be borrowing $500,000, right? But there's a bank out there that will do that. And so typically it's the max that you'll see is 5x whatever your active income is. Okay. But that starts there. So let's say I make $100,000 a year W-2, and then I bought my first short-term rental for $300,000. I put $60,000 down, and then I finance the other $240,000. Okay, well, there goes half my debt to income limit, right? Until 1 year goes by, and now I can add the revenue from that short-term rental to my income. So then I can borrow more than that. I could use that. I could borrow that $250,000 plus more after that first year. And this is what's important for everybody to understand. When it comes to short-term rentals, you only need 1 year of tax return to help you use that income to qualify for another deal. Don't let anybody tell you that you need more than a year, one tax return. In fact, you don't even need a full year. They should be breaking it out by months. So if let's say I bought a property right now this September, and I rented it out October, November, December of 2024, that's 3 months. That's 3 months of income that when I go to file my tax return in 2025, they'll prorate that out for the rest of the year. So if I made $3,000 a month for those 3 months, they'll take that and they'll say I make $3,000 every month. And then they'll use that as calculations for when I want to go buy my next property.
Gotcha.
Mm-hmm.
Yeah. So is that, I guess, rolling into my next question. So for people who are looking to purchase, I know like 2016, around that time is when I started like learning about real estate and how to invest. And a lot of times what I heard was like, there's a 1% rule when you're purchasing. Like if you buy a home for $1 million, you should be able to rent it out for 10,000. I feel like I rarely see that now. Do you think that's even possible anymore?
So the 1% rule was based on long-term rents and basically like long-term rentals and multifamily comps, which you still see in areas probably only the Midwest. I honestly, there's a couple of stuff even out by me, suburbs of Chicago, that hits the 1%. I know there's a lot of units out in Ohio and even parts of Indiana that hit the 1%, but you're not really seeing that 1% rule anymore. I'll tell you on a long-term rental and multifamily side, what I'm really looking at right now are two different things. The first thing is I'm looking at an overall cash-on-cash return. If at the end of the day I can't cash-on-cash return 10%, right, I'm not going to do the deal. Because if I can get 10% cash on cash, that's 2% more than I would have gotten in the stock market. Plus, I'm getting all those other benefits of appreciation, loan pay down, and tax benefits. So that 10% cash on cash really turns into like a 25% overall return when I factor in all those other benefits. That to me is worth it, and I'll do that instead of the stock market. Okay. So cash on cash is what I look at for long-term or multifamily. The other big number that it might be everybody's first time hearing this is what's called cap rate spread. Okay. So the cap rate, which is what a lot of multifamily trade off of, is just like an earnings multiple. You know, if I have a $1 million property and it nets $100K a year, my cap rate's 10%. Okay. Now, what the cap rate spread says is the difference between whatever your cap rate percentage and your interest rate should be at least 3%. Okay. So on that example, I have a 10% cap rate, right? And a 3% spread would mean my interest rate on that deal can't be higher than 7%. And if you can, it is basic math. It's like third and fourth grade math. But if you can understand that, and it makes all the sense in the world, because if those interest rates go up or down, they're so volatile where if they go up 1 or 2%, you're losing money on the property. So
Yeah.
I need 10% cash on cash, and I need at least a 3% cap rate spread. Those are the two numbers that I look at with multifamily. Now, you threw out the 1% rule. For short-term rentals, a quick back of the napkin is just do 15% of the purchase price. You know, if you can't get 15% of the purchase price and gross revenue for the entire year, don't buy it. Okay. So if I'm buying a $500,000 short-term rental, I should be able to rent it out for 70 to 75K. Okay. If you can hit that gross revenue test, as long as you don't have something exorbitant like, Florida property taxes, or, you get stuck in a flood zone or something like that, all the other numbers should fall in line. If you can hit that gross revenue, everything else will fall in line. But it's 15% of the gross revenue of the property for short-term rentals.
So with that in mind, I guess talking from a cash flow perspective, is it okay in your eyes to go cash flow negative right now, assuming that the interest rates go down?
Well, see, that's the bad assumption, is assuming that they go down. I would go break even right now if somebody had to. We get, and I obviously don't recommend it, because if you're a client of mine, or you've probably heard me say this, like, you don't want to buy real estate just for the tax benefits. But there's some investors out there that are like, hey, I'll break even, or maybe I'll make a couple $100 a month on this property because there, at the end of the day, there is somebody that's paying off this mortgage and I'm saving a lot in taxes. But I've never, and I never will ever buy a property that's cash flow negative. It's the people that do those types of deals that 2 years later they end up selling the property because it's bleeding money anyway.
Yeah, something I didn't know when I bought my first property was, I guess it's the amortization schedule of like how much interest you pay up front. I think I bought my house for a year and a half, and I probably put down maybe $9,000 equity max. My mortgage is like, a good portion of that per month. So it's crazy, like the percentage of interest that you're paying up front. Right now, it's I've heard a lot of people argue that it's even more beneficial to just rent until the interest rates go down.
Yeah, I think from a personal investing standpoint, it's really hard, especially as a person who they've never bought a home before, or they're just buying their second primary. You as an individual investor, there's zero chance you're timing the rates. You're not competing with these guys on Wall Street or these big banks that have economists and data nerds and things like that. So to time the rates as an individual investor is a fool's game, in my opinion. Actually, anybody to try to time the rates is fools. What you do if you're trying to buy your first primary home is, as long as the mortgage payment can be less than 30% of your take-home pay, that's when you buy your first house, in my opinion. You can maybe push it up to 40% if you don't have any other consumer debt like car loans or student loans or something like that. But I don't, for a personal property, I don't really try to time rates at all. I just do it whenever it makes sense for you financial wise. Because to your point, like, yeah, rates might be at 6.5% or 7% right now, but I'm going to lock in a 30-year. That's 30% of my take-home pay. And so as I get raises and as I get bonuses in the future, it's going to be less than 30% of my take-home pay. And in the future, if the rates do go down, well, then I just refinance and do a lower amount. So that's what I tell people from a personal investment. Now, if you're buying a property as an investment property, I think that's where your exit strategy becomes super important. Because to me, if you're going to buy a property and you're like, yeah, I'm going to hold on to this thing forever. This is a gold mine. Like, I'm going to keep it forever. Then I'm fine with you putting 10%, whatever you can do to get your foot in the door on that property and just to hold on to it, right? But if you're like, hey, I think there's a good chance that I move away from San Diego in 5 years or 6 years, and I don't want to hold on to this thing forever, maybe 5-6 years max. In today's environment, like I'm putting 20-25% down instead of 10, because those, the 5 or 6 years that you held on that property, all that equity got basically eaten alive by the amount of interest that you've been paying. And so on a 5-year time horizon, you come out way ahead by just putting more equity down up front and not losing out on that interest than the opposite, knowing that you're just going to get the equity back hopefully when you go to sell it in 5 years. Yeah.
100%. Yeah, I think the play for me right now, like with my property that I have, I know there's development potential in the future, and that was kind of my goal when I bought it, was like, now doesn't seem like a great time for me. But I know if I put down a decent amount, and I wouldn't say it's a gold mine, but it's one of those properties where like I'm gonna keep it for a long time. It wasn't like I'll just purchase for now, get a little bit of equity, and then sell it, because like mortgage is crazy. The only way I could make it work was because there's a multifamily property that I was able to rent out one as a short-term rental. But I can't even imagine if it was like rent controlled or something. I probably wouldn't. I'd be struggling just to make total mortgage payment based on that because of the interest.
Yeah, and it's so funny because when I first learned finance, it was Dave Ramsey stuff, super basic caveman way to learn finance. And then you go to college, you get 2 degrees, you go to the #1 public accounting firm in the world, and they throw out all these numbers, like all these ratios, price to earnings, cap rate, all these numbers that people talk about. But at the end of the day, like if you cannot do the math on the back of a napkin, it ain't a good deal anyway. You don't need to know all these fancy terms and multipliers and ratios. All you need to know, you learn by 3rd grade, and that's addition, subtraction, multiplication, and division. That's all you need to know to do real estate, truth be told.
Yeah, that's encouraging for me when I'm analyzing deals. I'm looking at trying to get into real estate investing, looking at like fix and flipping and stuff like that. And a lot of the costs are just unknown to me. A lot of times, like, you have a gut feeling how much something's going to cost. But getting into any field, I think it's always tough to make that analysis. Do you ever have people that come to you with like failing properties who like just grossly underestimated the operating cost of a certain rental?
Yeah, that's the thing that we want to do first is, and I have a training on this. I don't know if I sell this online anymore. I think it's just for people that are in that service. But it goes into the 3 different tests that I talk about of a property. So the first test of a property is the gross revenue test. That's what we already learned today, the 15% of the purchase price. That's test number 1. Test number 2 is what I call the operating expense ratio test. And again, here we go with these ratios and these tests and these numbers, right? I need to come up with an easier way to teach this. But that basically says, okay, of your gross revenue, you're going to have close to about 30 to 35% of your gross revenue is going to go away for operating costs. Okay. So I'm talking cleaning, supplies, maintenance, repairs, CapEx, insurance, and property taxes. Like all those things go into that operating expense, typically 35% of the gross revenue. Okay. And then the last thing that you're going to be left with is what I call the debt service test. So that's mortgage principal and interest should be no more than 40% of your gross revenue. Okay. So if I'm grossing 10K a month, my mortgage payment, principal and interest cannot be more than 4K. Okay. And if you can look at a deal and it checks all 3 of these boxes, there's no way you lose money on the property. It's like mathematically impossible for you to lose money because you checked all 3 boxes. Now, when I get somebody that has an underperforming property that comes to me, the first thing I do is let's go get the last 12 months of this property and put it into this test. Okay, where did you fail? Oh yeah, your revenue was right, your expenses were okay. You just bought at literally the worst time in the world. If you would have bought it at 6% instead of an 8%, like this would be making 20 grand a year, but you didn't. Now you're losing 5 grand a year, right? I'll never forget this. We were doing I was doing a coaching program. I think this was like late 2022. Late 2022, I think we actually did the program, and then we had a graduation for everybody in the spring of 23. And I'll never forget, like, I was telling this story of how I was working with an investor, and I told her, I was like, yeah, your revenue's fine, your expenses are fine. I think you just bought at the wrong time. And I was telling this story in front of this crowd of 200 people, and this woman like jumped up and she's like, yeah, that was me. Like, that was me you told it to. She started laughing, but I mean, it's true. Like, you should be able to look at a property, their trailing 12 months performance, and analyze where exactly did they go wrong. Did they miss the mark on revenue? Did they miss the mark on expenses? Or did they just buy at the wrong time? And then once you know that, it'll make you a better investor because you'll know what to look for next time and where you went wrong. But then that's where you make your decision. How much equity do I have in this property? 200,000. It's making me 5 grand, 7 grand a year. Well, I'd have to rent this thing out for 40 years just to make back my equity in the property. I probably should sell it, or get rid of it. So,
Yeah, good stuff. I heard you talk about something called the STR loophole. Could you
hmm
discuss that briefly? I don't think I ever grasped exactly what that is for short-term rental hosts.
yeah. So to fully understand the STR loophole, you have to understand that for 90 years, people who bought real estate and were also like doctors or business owners or things like that, they were able to offset their business income with real estate losses. Okay. So the joke used to be 2 doctors buy a rental property together. What do you call it? A tax shelter. Because they would just they would just use the losses to offset their doctor income, right? And then it wasn't until
Gotcha.
the early 1990s. So like I said, the tax code was invented in the early 1900s. It took them 90 years to plug this loophole. And that was the whole offsetting business income with rental losses. And so in the early 1990s, Congress put a stop to that. They said, hey, look, like, you as a doctor shouldn't be able to buy real estate and offset all your doctor income. So they put a stop to that. But they left one little exception out. And that in that when they wrote that code in the early 90s, one of the things that they said in there was, hey, if you have a property that you rent out for 7 days or less on average, it's not actually a rental, it's a business. And if you are actively involved in that business, you could take the losses from it and offset your business or your W-2 income. And so what Congress didn't realize when they wrote that code in the early 1990s is they anticipated it just being small mom and pops, hotels, motels that would qualify for that exception, let's call it. They didn't anticipate you and I to own properties and put them up on Airbnb, right? So that's why it's called a loophole, because it is a true loophole in the tax code where Congress didn't intend it to be this way, but that's just how they wrote the code. You hear like other like influencers and gurus throw out the term loophole, this and that, but they're talking about easy strategies, 1031 exchange, putting your property in trust, things like that. Those are not loopholes. It's in the tax code that you can do that. This is a legit loophole where they did not intend it to be this way, but it allows you as an investor to write off all the rental losses that you get from being a real estate investor against your W-2 income. And when I say it's the best thing since sliced bread, it really is, because what's crazy is you can put 10% down on the purchase price, right? So 10% down of $1 million property, and then I'm able to write off typically 25% of the purchase price. So I'm taking a $250,000 deduction, which is 25% of $1 million. I'm taking $250,000 against my W-2. So if let's say I'm a guy, I made $250K as a W-2, right? I'm gonna take 100 of this 250 and I'm gonna buy a rental property with it. So then I go and buy that $1 million property. Well, I just offset all my taxes on that W-2 with that one investment, and I'm still up with 150K after the year's over. Well, and then living expenses, of course, but you see how I'm saying? And that's how investors are scaling their portfolio super quickly, is because of the tax loophole.
Is there a way that that applies to multifamily properties if the owner is living on site?
The only problem with multifamily is seen as a true rental property. And so because of that, you have to be what's called a real estate professional, which means you have to be a realtor, property manager, broker, construction in order to qualify. What's so great about the short-term rental loophole is you could just be a normal doctor, dentist, you could be a tech worker. I mean, you could work at a grocery store and qualify for the loophole. You don't have to be full-time in real estate.
Gotcha. And
Mm-hmm.
is depreciation considered one of those losses?
Yeah, I mean, there's going to be a lot of losses, especially in the first year. Like depreciation is going to be probably the biggest one, right? But you're also going to be renovations and repairs that you put into the property. As you know, probably mortgage interest that you're writing off is going to be an expense. Property taxes, insurance, and so when you add it up, and I've done a lot of math on this, but in most cases, people are getting 30 to 40% of their down payment funded by the tax savings of an investment property. So, like you talk about a way to boost your overall cash on cash without investing any more money, go learn how to save 20, 30 grand in taxes, because the money's already sitting there in the property that you just bought and you're managing. You just have to have the knowledge and wisdom to be able to apply that so you can actually save some serious money.
That's huge.
Yeah.
Yeah. Wow. Super cool. I guess when it comes down to deductions, then is there a standard expense that you see STR investors typically forgetting about when, I guess, budgeting or is there something where I guess not necessarily expenses, but if we're talking about strictly deductions, is there something where people have come to you from previous CPAs and they're like, this is what I've gotten back, my return, and then there's something immediately right off the bat that you're like, oh,
Yeah.
we gotta look at this.
Well, I would say on the acquisition side, the number one thing that a lot of investors miss is property taxes. You got a building in California that's Prop 19, or it's been owned by a mom, it's been owned by a family for 15, 20 years. That thing hasn't been reassessed in a while. The minute you buy that property and the sale is going to trigger a reassessment, who knows how much that property tax bill is going to go up? I mean, it could go up double, triple potentially.
Mm-hmm.
And so you have to be factoring in that in your underwriting when you're going to go buy a deal. You can't count on the listing agent realtor. You can't count on the broker. They're going to give you what the current property tax amount is. You have to know how much that's going to be after you buy the property. So that's a mistake that I see. And then on the expense or deduction side, I would say the number one thing that I see is just missed travel costs, right? So driving to and from your rentals, or if you have rentals out of state, a lot of investors aren't writing off the travel costs to and from those properties. This cell phone device that I got, I run 3 businesses from this phone. I also call my wife and my mom on this phone too, so not 100% of it's fully deductible, but I'm using this 90% of the time for my business, so that's a deduction for my business, right? And then the biggest one of all that I would say that I see missed is closing costs. Like just straight up closing costs on a property. Typically, most of the time, they're going to be about 3% of your purchase price. So if you buy a $500,000 home, that's going to be $15K in closing costs. You'd be surprised at how many CPAs or people that do their taxes with H&R Block or TurboTax that they miss a $15,000 deduction on their tax return. Like, you'd be surprised at how many people miss something as simple as that, but it's true, and it happens all the time.
Yeah, definitely. Uh, is there a particular place in the United States? Because I assume you work with people all across the United States. Is there a particular state that is the easiest on taxes for real estate investors?
Probably Tennessee, I would say, and the reason is the 2 things I'm looking at are state income. Actually, 3 things: state income taxes, which Tennessee has none. Florida has none. That's another hot spot. New Hampshire has none. Texas has none. That's another hot spot. There's like 9 states that have no. Nevada has no state income tax, right? So like any state that you can invest in that's tax free, you're already boosting your returns a little bit because you don't have to pay state income tax there. Um, but the second thing that I look at is property tax. So Tennessee, you buy $1 million home in Tennessee, the property tax bill is like $4,000. I just bought a $500,000 home here in Chicago. My property tax bill is $12,000 a year. It's insane. It's ridiculous, right? But then the third and final thing that I look at is how much of that purchase can you actually write off? Because you can only write off the portion that's allocated towards the building value when you buy a property. And then the Smokies, because the land's not worth a lot, you can write off so much more than if you were to buy a property in San Diego, Gulf Shores, Destin, 30A, New York City, where the land value is half the purchase price, maybe even more. So looking at those kind of factors, you want to invest, if you're looking for tax benefits, you want to find a state that has no income tax, that you can write off a good portion of the purchase price, and then also your property tax bill just isn't ungodly high either, And to me, Tennessee kind of checks all those boxes for an investable state. And then now the one thing, if you are an investor that is looking for tax benefits, and you are investing in a California or a Florida or one of those other states that I said that has super high property taxes and land value, you might want to look at condos or townhomes, because when you buy a condo or a townhome, you don't actually own the land that the building sits on most of the time. And so if you buy $1 million property in San Diego, but it's a condo, you're still going to get $1 million worth of tax benefits. Versus if you bought $1 million single family home in San Diego, you might only get $500,000 worth of tax benefits. Does that make sense?
Yeah.
Yeah.
I know it came as a surprise to me when when I purchased my house. It's the supplemental tax bill that came through, which I guess is like the difference between the previously assessed value of the home and the new value, and then times, what is it, 1.25% or whatever it is in San Diego. I was like, holy shit. I was not ready for that. Because my house was a flip. So I bought it
Mhm.
basically newly renovated. And the previous value was like almost half the price.
Yeah, and so that's luckily that something like that you should be able to almost figure out before you buy the property.
Hmm.
And the easiest way to do that is go look at 5 of the recent comps within the last year that have sold that have similar bedroom, bathroom, square footage count, and figure out how high their property tax bill went up, because it's all public record. So you should have
Sure.
been able to see, okay, this guy went from $4,000 to $5,000, so that's about a 25% increase. Well, I could probably expect mine to go up by similar to that. And then use that as your number instead of whatever the realtor is giving you. Use that number that you just calculated.
Yeah,
Mm-hmm.
definitely. Cool, man. Well, the last question I want to leave you with, is what is the strangest expense someone has tried to pass off as a business necessity? Is there anything that comes to mind?
I haven't had any weird ones. I've definitely had some other CPA friends that have had like, I had one guy who, uh, one of my friends was telling me they had a client that was like writing off their escort payments, and like the guy's wife found out about it or something like that, something crazy like that. I would say, I mean, the craziest thing that I've seen is just people that are like super bad business owners. Like I had a real estate client who she made like $100,000 gross revenue, but then she submitted something that said she had over almost $250,000 in like expenses on Zillow for like Zillow leads or something like that. So I guess Zillow partners with realtors, and a realtor can
Mm.
pay Zillow to get featured on there or something like that. And I'm like, let me get this straight. So you were putting in $2.50, and out popped $1, and you thought that that was a good, So it's just like things like that where they're not just the most savvy people on the planet. Um,
Yeah,
but I haven't seen
that's
anything
cool.
too exotic. Yeah,
Yeah. Cool, man. Yeah, well, I appreciate you being on.
you're welcome.
There's a ton of dimes that little, good pieces of info that you've already provided. So I'm excited to share those things with the viewers, and we'll definitely keep in touch. I know you have a lot of interest in I guess the real estate industry, but also we kind of cross paths with both of our businesses with Host Buddy AI, and a lot of ventures that you're doing. So I'm sure we'll keep in touch. And yeah, thanks for being on. We'll talk soon.
Yeah, you're welcome.